May 2024, Orlando, Florida. The blistering afternoon sun beats down on the melting asphalt of an empty Red Lobster parking lot. The neon lobster sign still hums loudly on the facade, but the glass doors are chained shut. The mainstream media tells you this happened because everyday Americans ate too much endless shrimp. They want you to believe a simple seafood promotion brought down a multi-billion-dollar empire. But step past the yellow police tape and look at the actual accounting. This was not a failure of consumer demand. This was a clinically executed financial extraction. It is a paradox hidden in plain sight. Here was a restaurant chain generating massive daily revenue, yet simultaneously bleeding to death on its balance sheet. The real killer was a spreadsheet in a private equity office, a financial blueprint designed to turn a healthy business into a desperate, debt-strapped tenant in its own building. They call this the Private Equity Playbook. We are going to rip open the ledger and show you exactly how the corporate vampires operate. But to see the first bite marks, we have to travel back a decade. Picture a mahogany boardroom high above Wall Street. The air conditioning hums against the heavy glass windows. It is a Tuesday morning, and the private equity partners are circling a perfectly healthy corporate target. The managing director points to the financial projections on a glowing screen. "How much free cash flow does this brand generate?" he asks the room. The lead investment banker slides a thick folder across the polished table. "Enough to comfortably service the massive debt we will use to buy it." The managing director smiles. "Good. Then we will buy them using their own future money, and we will charge them a fee for the privilege." This is the foundational secret of modern financial engineering. You do not use your own money, you use theirs. If you want to stop falling for media narratives about changing consumer tastes, and join the few who actually understand the financial systems running our world, hit the subscribe button to Capital Curriculum now. We are decoding the mechanisms that transfer wealth from the working class to the penthouse. And the first mechanism you must understand starts with the buyout. Let us break down the leveraged buyout, or LBO. Imagine you want to buy a house. Normally, you take out a mortgage in your own name. If you do not pay, the bank takes your house and ruins your personal credit. But in the private equity version of reality, the rules change entirely. Imagine buying a massive, fully furnished mansion. You put down maybe 20% of the asking price. For the other 80%, you take out a massive loan. But you force the house itself to sign the mortgage documents. You put the debt on the target company, not the buyer. Picture a ledger chart where a giant red block of debt is dropped directly onto the balance sheet of a previously healthy company. The private equity sponsors take out advisory fees up front, regardless of whether the business survives the next decade. The company is now highly leveraged, forced to use its daily cash flow to service a staggering debt load instead of modernizing its operations. The house is paying its own mortgage, while the new owner charges it an administrative fee just for existing. This creates an incredibly asymmetric payoff structure. The debt is non-recourse to the private equity firm. This means if the market turns, if interest rates spike, or if a global competitor arrives, the private equity firm is not legally responsible for the debt. "If the company goes bankrupt," the managing partner whispers to his limited partners, "the lenders lose, the employees lose. But we have already extracted our management fees and dividends. We walk away clean." The downside risk is entirely outsourced to the host. The vampire has taken its first bite. The target company is now financially compromised, stripped of its shock absorbers, and entirely dependent on flawless market conditions to survive. But this is just the theoretical framework. To see the true destructive power of this playbook, we have to look at the collateral damage. We have to look at an empire built on childhood joy, systematically dismantled by a weaponized balance sheet. The biggest victim of this first wave was not a struggling startup. It was the largest toy store on the face of the earth. 2005, Wayne, New Jersey. The fluorescent lights of the Toys R Us national headquarters hum with quiet efficiency. The endless warehouse aisles are packed floor to ceiling with bicycles, video games, and board games. It is a healthy retail giant, an American institution. But a shadow is falling over the loading docks. A consortium comprised of KKR, Bain Capital, and Vornado Realty Trust arrives in the executive suites. They are not here to build better toys or redesign the stores. They are here to deploy the LBO playbook on a massive scale. Picture the executives walking the floor, looking past the merchandise and seeing only cash flow yields and collateral value. They see a target with enough brand loyalty to sustain a crushing debt load for at least a decade. The retail employees stocking shelves have no idea that the ground beneath their feet has just been financially strip-mined. The paperwork being signed on the top floor is about to turn this beloved retail fortress into a ticking time bomb of unpayable leverage. Inside the final closing meeting, the numbers are staggering. "We are taking it private for $6.6 billion, the lead sponsor announces to the room of lawyers. A junior analyst looks at the capital stack. "But we are only putting in about $1.6 billion of our own equity. Where does the other $5 billion come from?" The sponsor taps the final page of the contract. "We borrow it, and we make Toys R Us the sole guarantor of the loan. The debt is only recourse to the company, not to us." The analyst realizes the implications immediately. So, if Amazon starts eating our market share, or if retail foot traffic drops, the company is on the hook for the entire principal. "Exactly," the sponsor replies. "But by the time that happens, we will have already collected our monitoring fees." The pens scratch across the paper. In an instant, a company with manageable obligations is loaded with more than $5 billion in debt. The financial noose is tied, and the clock begins to tick down to liquidation. Imagine a pie chart representing the company's total annual revenue. In a healthy company, a large slice of that pie goes back into the business. You use it to modernize stores, build out e-commerce logistics to fight Amazon, and lower prices to compete with Walmart. Now, imagine a giant vector arrow violently pulling $400 million out of that pie every single year. That is what Toys R Us was paying just in interest to service their newly assigned debt. The business was generating cash, but the cash was immediately evaporating into the bond markets. They had no buffer. Any cyclical retail downturn or competitive pressure met a company with zero financial cushion, no escape route, and no access to capital markets without further leveraging itself. Picture a heavy cargo ship trying to navigate a storm, but the captain has been forced to sell all the lifeboats to pay for the fuel. The operation looks normal from the shore, but internally, the engine room is flooding, and the crew is entirely trapped by the mathematics of the capital structure. By 2017, the inevitable mathematics caught up with reality. The cargo ship sank, Toys R Us stumbled into bankruptcy, and 33,000 retail workers lost their jobs. The stores were liquidated, the shelves stripped bare. But look at the private equity sponsors. Even as the company marched toward its corporate death, KKR, Bain, and Vornado still extracted about $464 million in fees and interest over the years they controlled it. The workers got severance lines, the sponsors got $500 million. Critics and policy advocates call this extraction by design. The structure was so aggressive that any economic shock would doom the business, while the sponsors were insulated and paid up front. But as lucrative as the traditional LBO was, the Wall Street engineers realized it had a flaw. It left too much value locked inside the company's hard assets. The vampires realized they were leaving money on the table. They needed a new structure, a cleaner way to strip the meat from the bone without waiting for the company to generate cash. They invented the OpCo-PropCo split. 2014. A dimly lit, brutally expensive steakhouse in Lower Manhattan. The air is thick with the smell of aged beef and expensive ambition. Private equity executives from Golden Gate Capital are sketching diagrams on linen napkins. They are looking closely at Red Lobster, a massive restaurant chain currently owned by Darden Restaurants. The brand has hundreds of prime real estate locations across the country. The executives do not care about the Cheddar Bay biscuits. They care about the dirt underneath the dining rooms. They see a company that owns its own land, which to a financial engineer is an unforgivable inefficiency. Why let a restaurant own real estate? One of them asks, dragging a pen across the napkin to draw a hard line down the middle of the corporate structure. We separate the meat from the shell. They are mapping out the dual entity model, a strategy that will forever alter the landscape of American retail and healthcare. They are preparing to slice a living company in half, creating a landlord and a tenant out of thin air. The mechanics are finalized in a boardroom meeting with a real estate investment trust, American Realty Capital Properties. We will buy Red Lobster for $2.1 billion, the Golden Gate partner explains. But the second the ink is dry, we are selling you the real estate portfolio for $1.5 billion. The REIT manager raises an eyebrow. You are selling me 500 restaurant properties. Who is going to occupy them? The partner smiles coldly. Red Lobster will. They will become a tenant in their own former locations. They will sign long-term leases with you today. The REIT manager nods, seeing the guaranteed yield. And the $1.5 billion in cash from the sale? He asks. That goes to us, to pay down our initial equity and fund a massive dividend. It is a perfectly synchronized double transaction. In a single afternoon, the restaurant chain is stripped of its most valuable hard assets and chained to a mountain of new rental obligations. The financial engineering is complete, and the slow strangulation of the operating company begins. This is the OpCo-PropCo split. Imagine a thriving factory that owns its own building. The private equity firm steps in and legally severs the company into two distinct entities. The operating company, or OpCo, keeps the brand, the employees, the inventory, and the daily revenue. The property company, or PropCo, gets the actual real estate. Picture a visual diagram where the OpCo is a restaurant kitchen, and the PropCo is a giant bank vault. Immediately, the private equity firm executes a sale-leaseback. They sell the vault to outside investors for a massive upfront cash infusion. But the OpCo still needs the building to cook the food, so they are forced to sign long-term leases at above-market rates. A massive vector arrow of cash now continuously flows from the OpCo cash registers directly into the PropCo vault in the form of mandatory rent. The private equity fund recoups its initial equity instantly via special dividends, locks in downside protection, and leaves the operating business highly leveraged and entirely devoid of hard assets to borrow against in an emergency. On paper, the business looks like it is operating normally. The signs are still illuminated, the hostesses are still seating customers, and the food is still being served. But structurally, the host has been hollowed out. If Red Lobster was historically a healthy, asset-rich company, it is now a fragile, landless tenant carrying immense lease obligations with virtually zero operational cash to invest in menu innovation or store renovations. The private equity firm has effectively monetized the company's past success and externalized its future risk. This is the vampire bite, optimized for the modern era. The blood has been drained, but the host is propped up to look alive for just long enough to keep the rent checks clearing. And as inflation rises and minimum wages increase, the suffocating weight of these artificial leases begins to fracture the restaurant's operational reality. The cracks are forming in the foundation, and the management team is about to realize that they are completely trapped inside a burning building that they no longer even own. 2023. A Red Lobster kitchen in Middle America. The fryers are hissing loudly, but the dining room is only half full. The regional manager sits in a cramped back office sweating over a glowing spreadsheet. The restaurant is losing money daily due to rising food costs and inflation, but the monthly fixed rent check is non-negotiable. He scrolls down the corporate ledger. The numbers are terrifying. Across the country, the company is saddled with $190.5 million in annual lease obligations. It is a staggering fixed cost that ignores the reality of the daily cash register. The manager looks out at the empty booths. In a normal retail environment, a company simply closes its underperforming stores, cuts its losses, and reallocates capital to its profitable locations. But he cannot close the store. The legal chains forged during the 2014 sale-leaseback are unbreakable. The company is trapped in an ironclad lease agreement, forced to bleed capital into a real estate trust, while the operational business starves for liquidity. The rent noose is pulling tight. In a frantic corporate restructuring call, the reality of the OpCo-PropCo split sets in. "We need to stop the bleeding immediately," the new CEO says to the restructuring advisor. "We have dozens of locations that are severely unprofitable. We have to shut them down and break the leases." The advisor sighs, looking at the master contract. "We cannot do that. The private equity sponsors locked us into long-term leases at above-market rates. If we walk away, the penalties will instantly bankrupt us." The CEO stares at the screen. "How much are we paying for empty rooms?" The advisor types a few keys. "Of the $190 million we owe annually, more than $64 million is strictly for underperforming stores. We are legally obligated to hemorrhage cash." The conversation stops. The business is being forced to subsidize its own execution. The payment of lease obligations associated with non-performing leases has caused an irreversible strain on the company liquidity. The financial engineering has overridden common business sense, prioritizing the landlord's yield over the tenant's survival. To understand how deeply extractive this is, picture a medical syringe pulling the last drops of capital out of a struggling patient. This is known as the leveraged dividend recapitalization. When the private equity firm realized the operating company was struggling, they did not inject new capital to save it. Instead, they forced the portfolio company to take on even more new debt. But this new loan was not used to buy new equipment or pay workers. The new debt was used specifically to fund a massive, immediate dividend distribution directly back to the private equity fund. It is a partial exit strategy disguised as corporate finance. Imagine borrowing $50,000 in your company's name, putting the cash directly into your personal bank account, and leaving your employees to figure out how to pay back the loan. The private equity firm gets their cash out well before any bankruptcy filing, leaving the operating company with higher debt, crushing rent, and absolute zero maneuverability. The vampire drinks its fill and leaves the hollowed-out host to collapse. When Red Lobster finally files for Chapter 11 bankruptcy protection in 2024, the structural truth is buried under corporate public relations. The mainstream media seizes on a convenient narrative. They blame inflation. They blame changing millennial tastes. They endlessly mock the endless shrimp promotion, framing it as a catastrophic management blunder that destroyed the company. The public laughs at the memes, entirely missing the sleight of hand. The endless shrimp did not kill Red Lobster. The unbreakable above-market leases and the dividend recapitalizations killed it. The complexity of the financial engineering creates a perfect smokescreen, allowing the true architects of the collapse to walk away entirely unblamed and vastly richer. Employees lose their livelihoods, local communities lose commercial anchors, and the limited partners quietly count their yields. But the private equity industry is not satisfied with retail chains. The playbook is too lucrative to keep constrained to toys and seafood. The vampires are seeking a new host, a sector where the real estate is massive, the cash flows are guaranteed by insurance, and the stakes are literal life and death. 2024, Massachusetts. The sterile, white corridor of a regional hospital. The overhead fluorescent lights are flickering slightly. A frantic nurse opens a supply closet only to find the shelves completely bare of critical cardiac monitors. This is a facility formerly known as Caritas Christi, recently acquired and rebranded by Cerberus Capital Management into Steward Healthcare. The waiting room is overflowing, but the administration has frozen all new hiring. The doctors are exhausted, rationing basic supplies like gauze and syringes. They think the hospital is suffering from a temporary budget shortfall due to insurance reimbursement delays. They are wrong. The hospital is suffering because the building they are standing in was quietly sold to a Wall Street real estate trust, and the rent is due on Friday. The exact same OpCo, PropCo spreadsheet that hollowed out a seafood chain has been aggressively deployed into the American healthcare system. And when you strip the financial shock absorbers out of a trauma center, the collateral damage is not a closed store. The collateral damage is measured in human casualties. Inside a secure conference room, the hospital executives sit across from Cerberus and Medical Properties Trust, a massive healthcare REIT. The terms of the extraction are being finalized. We are executing a $1.25 billion sale-leaseback of the hospital properties, the Cerberus partner dictates. An executive nervously asks the critical question: how much of that cash infusion stays with Steward to fund patient care and hospital operations? The partner taps his pen. About $75 million remains for operations. $385 million goes to pay down secured debt. The executive pales. That leaves almost $800 million unaccounted for. That goes to us, the private equity partner replies cleanly. $719 million to Cerberus, including a $473 million special dividend, and $71 million to top management. The transaction executes flawlessly. The private equity firm mostly gets its money back instantly, plus a juicy dividend. The REIT gets a sprawling portfolio of hospital real estate with guaranteed long-term leases. And the actual hospitals are left with staggering new rent obligations, deeply reduced equity, and virtually no financial operating cushion. When a hospital is forced into an OpCo-PropCo structure, the fundamental mathematics of patient care are corrupted. Imagine a hospital's monthly budget as a giant scale. On one side, you have the operational necessities: emergency room nurses, surgical equipment, and life-saving drugs. On the other side, you have an unyielding, multi-million-dollar corporate rent obligation owed to a massive real estate trust. Because the private equity debt is non-recourse, the hospital bears all the structural risk. Picture a vector arrow funneling cash directly from the intensive care unit's budget straight into a landlord's dividend pool. When revenue dips, the rent cannot be cut, so the resources must be. The administration is forced to aggressively reduce staffing ratios, substitute cheaper medical supplies, and close less profitable yet clinically vital hospital wings. The operating hospital must meet its debt service targets at all costs. The financial engineering operates with a terrifying mechanical apathy toward the actual product being delivered. In retail, this mechanism results in cold French fries. In an emergency room, the margins of error are brutally unforgiving. The collapse of Stewart Healthcare led to significant facility closures and severe financial distress across multiple states. But the industry claimed these were isolated incidents, purely the result of pandemic headwinds and labour shortages. They hid behind the complexity of the sale-leaseback, confident that the public could not connect the real estate transaction to the empty supply closets. But then, the Journal of the American Medical Association dropped a bombshell peer-reviewed study. The researchers bypassed the corporate PR and looked directly at the clinical data. They tracked what actually happened to human beings when private equity took over their local hospitals. The numbers they uncovered stripped away the final illusions of the vampire playbook. It was no longer a debate about efficient capital allocation or optimizing asset yields. The spreadsheets were leaving a highly quantifiable trail of destruction. The academic data proved exactly what the exhausted nurses already knew. The financial extraction was directly linked to a terrifying spike in patient mortality, triggering a systemic crisis that regulators were entirely unprepared to handle. A sterile, brightly lit research lab at a prestigious medical university. A lead researcher leans closely into their monitor, highlighting a terrifying statistical anomaly across hundreds of data points. They are analysing hospital acquisitions by private equity firms, comparing them to matched control hospitals. The data is unambiguous. The researcher circles a chilling number: a 2.7 percentage point increase in 30-day post-operative mortality at private equity-owned facilities. But the true horror lies in the secondary metric. The increase was not driven by doctors making more surgical errors. The complication rates remained exactly the same. The deaths spiked primarily due to a 3.9 percentage point increase in something clinical researchers call failure to rescue. When a patient crashed, the hospital simply lacked the nursing staff, the rapid response equipment, or the administrative bandwidth to save them. The effect was particularly pronounced during unplanned and emergent surgeries. The financial engineers had optimized the hospital's cash flow so aggressively that they had mathematically engineered away the facility's ability to handle human emergencies. The spreadsheet had achieved perfect efficiency by sacrificing the patients. In the administrative wing of a struggling private equity-owned hospital, a senior surgeon violently pushes open the door to the chief financial officer's suite. "We have a catastrophic failure to rescue rate on the surgical floor," the doctor yells, slamming a clinical report onto the desk. "We need more critical care nurses immediately, and the monitors on the third floor are failing." The CFO does not look at the clinical data. He looks at the debt schedule on his monitor. "I cannot approve new hires, and I cannot approve capital expenditures for equipment." The doctor is furious. "Patients are crashing because we are understaffed. Where is the operating budget going?" The CFO points to the master lease agreement. "It is going to the real estate trust. We have to make the mandated rent payment by Friday, or we trigger a default covenant on the master loan. Cut the staff." The conversation ends. The biological reality of the patient has been entirely subordinated to the mechanical reality of the leveraged lease. The corporate vampire does not stop feeding just because the host is dying. Why does this legally sanctioned looting continue? Because the structural features of corporate law protect the architects. The massive debt is entirely non-recourse to the private equity firm. The complexity of the OpCo-PropCo split ensures that local communities and frontline workers rarely see the full picture until it is far too late. The executives utilize asymmetric payoffs. Heads, the firm wins through management fees, advisory fees, and massive dividend recapitalizations. Tails, the portfolio company dies, but the firm still keeps the cash they extracted. The limited liability shield protects the private equity sponsors from the fallout of the bankruptcy, or the clinical failures. A legislative proposal known as the Stop Wall Street Looting Act aims to dismantle this shield by increasing joint liability for private equity firms and lenders, effectively restricting certain kinds of ruthless fee extraction and asset stripping. Picture a legal mechanism that forces the vampire to stand in the sun, tying the personal wealth of the financial engineer directly to the long-term survival of the host company. But as of right now, the playbook remains entirely legal. The Stop Wall Street Looting Act is currently stalled in committee, fighting a massive lobbying apparatus funded by the very fees extracted from these hollowed-out companies. The spreadsheets are still running, calculating the liquidation value of the next beloved brand or regional medical center. The systematic transfer of wealth from local communities to offshore limited partners is not slowing down. It is accelerating into new sectors like veterinary clinics and single-family homes. The next time you see a beloved local chain mysteriously fall apart, or a neighborhood hospital suddenly unable to afford basic supplies, do not blame changing consumer preferences. Do not blame the nurses, and do not blame the shrimp. Blame the OpCo PropCo spreadsheet that turned a healthy business into a debt-strapped tenant, quietly pumping the lifeblood out to the financial elite. If you want to understand the blueprints of this engineered corporate decay before it hits your industry, subscribe to Capital Curriculum. We will keep exposing the ledgers. The financial vampires are already looking for their next host, and ignorance is their greatest asset.